All right, let's just jump right into this explainer. Today, we're unpacking a really fascinating situation playing out in the semiconductor space, specifically looking at Allegro MicroSystems, ticker symbol ALGM. If you've been watching their recent financial reports, what we're basically witnessing here is a classic high-stakes tug of war. On one side of the rope, you've got this booming, explosive sales growth driven by massive megatrends like AI and electric vehicles. But on the other side, you have rising macroeconomic costs pulling aggressively in the exact opposite direction. It's a literal battle between incredible top-line growth and shrinking bottom-line margins. So, right after their latest earnings dropped, ALGM's share price took a pretty noticeable hit. We saw it slide from over 51 bucks down to around $47. The market clearly had a bit of a negative knee-jerk reaction. But the crucial question for us today is whether this post-earnings dip is actually a prime buying opportunity. I mean, is this just a temporary speed bump in an otherwise great long-term growth story, or are we looking at a structural issue that should definitely keep us on the sidelines? To figure that out, we need to look directly at the numbers. And this slide right here perfectly illustrates that tug of war we were just talking about. On one hand, Allegro posted a massive top-line revenue beat, bringing in $243.2 million. That is a staggering 26.1% increase year over year. Phenomenal growth, right? But that incredible growth clashed directly with a really painful bottom-line earnings miss. They posted a GAAP loss of 9 cents per share, which significantly missed expectations. You honestly rarely see such a massive divergence between how much a company is selling and how much profit they're actually managing to keep. Let's actually break down this raw data. So revenue beat the street by 3.2%. Okay, great. However, look at adjusted EBITDA. That's earnings before interest, taxes, depreciation, and amortization. It came in at just under $50 million. That is a 10.4% miss compared to what analysts were expecting. To really understand if Allegro is a solid investment right now, we have to dissect exactly what is causing this top-line boom to absolutely collide with this bottom-line squeeze. Let's start with the good news. The sheer, undeniable demand driving those sales is incredible, and it's totally by design. CEO Michael Dug pointed out massive momentum in 3 specific areas. First up, AI data centers. You know how AI server racks require more and more intense power density? Well, they need highly efficient cooling fans and super precise current sensors to handle that, and Allegro is actively winning those designs. Second, the automotive sector. EVs are rapidly transitioning to high-voltage 800-volt architectures, and advanced driver assistance systems are basically standard now. That requires complex power management. And third, industrial automation. Their sales in robotics literally doubled year over year, especially with some big design wins in China. The demand is absolutely there. But here's the other end of that rope, and this is exactly why the stock dropped. CFO Derek D'Antilio was super transparent about the severe cost pressures that are actively eating into their gross margins. The company relies heavily on precious metals, specifically gold, in its manufacturing process. And we all know gold prices have been surging. Add to that rising fuel prices, general manufacturing pressures, and those lingering global logistics constraints. Basically, the fundamental cost of doing business and making these complex chips has skyrocketed way faster than the revenue has grown. So, to figure out if Allegro can survive this margin squeeze and actually regain their profitability, we have to look at their technological moat. Like, why do customers choose them over some cheaper alternative? It really comes down to their shift from older, traditional components to premium TMR, or tunneling magnetoresistance sensors. These next-gen magnetic sensors offer much higher sensitivity, they consume way less power, and they have a smaller physical footprint. If you're an automaker trying to build a reliable, fast-charging 800-volt EV battery, you literally need this level of precision. It's mission-critical tech, not just a cheap commodity. And this deep tech portfolio serves as their ultimate competitive shield. Allegro holds a dominant 28% global market share in magnetic sensor ICs. That's backed by over 1,500 active patents and these absolutely crucial functional safety certifications known as ISIL-D. Sure, they're facing heavyweights like Infineon and Texas Instruments, plus some really aggressive state-backed Chinese firms trying to drag prices down in the lower tiers. But Allegro's strict focus on high-performance, safety-critical applications keeps them firmly parked in the premium tier. It completely insulates them from that brutal race to the bottom on price. So how is management actually fixing this tension between high costs and premium demand? Well, they just pulled a massive lever. According to a recent customer notice, Allegro officially implemented a minimum 10% price increase across their entire product portfolio, which just took effect in late April. The company pointed out that they'd absorbed most of the cost pressures over the past 2 years without passing them on to the customer. But to maintain their supply chain and fund future investments, they finally had to act. This is going to be a massive test of their true pricing power. Actually, it's not just about raising prices. Management is actively restructuring their own operations to defend profitability with this three-step margin recovery plan. Step 1, like we just discussed, is that 10% targeted price hike. But Step 2 is a truly fascinating pivot. They are transitioning their manufacturing processes completely away from highly expensive gold and moving toward copper. That is a massive shift that's going to significantly slash material costs once it's fully rolled out. And Step 3 is a broader push to improve overall factory operational efficiencies, which should directly offset some of that lingering logistics inflation. All right, let's zoom out and look at how all of this feeds into the bigger picture for the stock. Despite the recent earnings volatility and the negative reaction to that EPS miss, the stock is still up over 52% over the past year. It's got incredible year-to-date momentum. What this tells us is that the market, while definitely a bit cautious about the short-term squeeze, still has serious confidence in Allegro's long-term trajectory. The overall trend here remains aggressively upward. And Wall Street seems to agree. Top analysts remain highly optimistic about the road ahead for this company. Currently, the consensus price target for ALGM sits at $53.58. From current trading levels, that suggests a near 35% upside potential. Analysts clearly believe that Allegro's unique position in massive secular growth markets, like AI and EVs, will ultimately overpower these temporary commodity headaches, especially once those 10% price hikes and that shift to copper manufacturing fully kick in. So as we wrap up this explainer, the ultimate question remains, and it's the one you need to consider. Can Allegro's immense pricing power and absolutely essential sensor technology outpace the rising macroeconomic costs of doing business? I mean, they've got the design wins in the world's most exciting industries, hands down. Now it is entirely a question of execution on that margin recovery plan. Keep a very close eye on their upcoming quarters to see if that clever shift from gold to copper and those new price increases actually start showing up on the bottom line. Thanks so much for joining me today, and I hope this deep dive brought some real clarity to the Allegro MicroSystems story.